So you're looking at getting into property, or maybe you've been involved in property for a while. You're currently looking at purchasing your next property deal, but you're looking at how you can actually finance that property purchase. Well, you've probably come across the term bridging finance. But what exactly is bridging finance, and what are the applications for it? Hi everyone, my name is Justin Goldie, one of the founders here at Goldson Homes. I run a property business with my brother and business partner Matthew, and we source, develop and manage HMO investments here in the south of the UK. Today we're going to be covering everything there is to know about bridging loans and what their applications are. So to start off, I think it's firstly particularly important to understand how a property is actually purchased. And this goes for residential properties as well as investment properties. So on a stock standard property deal, you'd be looking at purchasing the property on a mortgage. So to do this, you would have to put down a deposit, and this would be a percentage of the purchase price. Now, how much of a deposit you'd have to put down depends on what you're actually trying to do with the property. If it's a residential property and you're looking to move into that property to live in it, you'd tend to pay a much lower actual deposit. If you're looking to rent the property out, so it would be a buy-to-let investment, you'd be looking at a minimum of 25%. Now, there are multiple factors that the mortgage lender will actually consider before giving you the money. One of their main criteria is if the property is actually mortgageable. Now, what does this actually mean if the property is mortgageable? Well, if it's unmortgageable, it will probably have one of these following issues. So if the property has any structural issues, so maybe it's got some subsidence and the property is falling over on one side, this is going to deem the property unmortgageable. The next is the actual construction type of the property. Most houses here in the UK are constructed out of, as you would assume, bricks and mortar. But if you have a different construction method, maybe steel frame, this may pose a risk to the mortgage company and they would deem that property unmortgageable. You may still be able to get it with certain lenders, but it's not going to be as easy as you think. The next issue that may arise is if the property goes under a certain leasehold. So if you have a property that is below 70 years left on the lease, most mortgage lenders are not going to actually give you a mortgage on this property just because it is higher risk for them. And then the most common issue that mortgage lenders will have is if the property is not inhabitable. So this typically means, does the property have running water? Does it have a kitchen? Does it have a place, well, to go to the toilet? Something where you can actually live. So if a property is not livable, you probably won't be able to get a mortgage on it. Now, if you're like me, you probably want to snatch up a bit of a deal. Now, most properties that are going below market value do have some of these issues, most notably the ones that have just been left to rot. Now, these are the properties where you can get them at a really good price, fix them up and sell them. However, to purchase them at that price where it is a much lower price than you want to pay for it, it probably means it's in a worse condition and you won't be able to get a mortgage. But what if you don't have the full cash amount to actually purchase the property? Well, you might be in a bit of a pickle. However, this is where bridging finance comes in. So a bridging loan is essentially a short-term mortgage. They typically last between 6 and 18 months and they allow you to get all that work that you need to get done to make the property more mortgageable. Once it is mortgageable, you can then refinance onto a different mortgage, which typically has better rates. And the added bonus of this is if you do an excellent job at refurbing that property and really boost the value, you can end up actually taking out quite a bit of money in a very short period of time. So some of the added benefits of using a bridging loan is the speed at which you can get the money. So a typical mortgage at the moment in the UK is taking anywhere between 2 to 6 weeks. However, at the time of filming, there is a bit of a shortage of underwriters at the moment, which is making applications take a lot longer. Bridging finance, on the other hand, can take anywhere between 5 to 21 days. So this is a much shorter time period, allowing you to complete on your property purchase in a much shorter time. So if you're looking at purchasing at an auction where they typically require you to complete within 28 days, a bridging loan can be perfect because you can get that money without actually having to wait, 2 to 6 weeks to get a mortgage. And now for one of the best things I think you can get out of bridging finance is that the bridging lenders are more than happy to lend you the money to actually do the refurbishment on your property. So whether you're using the bridging loan to purchase the property and do it up, or you're just using it to refurb the property, this is where bridging finance can come in handy. So if you do not have enough money to maybe purchase the property and refurb it, but you have enough to just purchase it, you can do that. Now, this does not all come for free. Bridging loans typically come at a much higher interest rate compared to regular mortgages. There are also a lot more fees. Well, the fees might be a bit higher than on a regular mortgage. And the other negative aspect that you get from using a bridging loan is the risk you're taking. Because of their short-term nature, you have to repay that amount in that time frame. If you don't, you could face a very high penalty and the property could end up getting repossessed. So what are some of the rates and fees that you will be looking at when taking out a bridging loan? Well, let's start with the rates. As you'd expect, these do vary with the economic environment. So different economic influences will change the rate that lenders are willing to offer you. Right now in the UK, you can expect to pay between 0.5% up to 2% per month. Now, the key thing to understand there is that bridging loans are calculated on a per monthly basis. So as opposed to doing it through a normal mortgage, which are charged per annum, so on a yearly amount, bridging loans are charged on a monthly basis. So right now, if you're looking at a 0.5% to 2%, you'd actually be looking between 6 and 24% per year. Now, this is much higher than the actual mortgage rates that you can get at the moment. This is currently sitting at around 5% over various terms. Now, why is it so high? Well, you are essentially taking out a loan from a private equity firm over a very short period of time. The other reason is, well, it's the risk that the lenders are taking. As I mentioned, you're most likely going to be purchasing a property that has something wrong with it. So there's a lot more risk in it for the actual lender compared to purchasing a property that has nothing wrong with it. So the lenders obviously need to incentivize for themselves and are going to charge you a much higher interest rate. Now, there are a few other fees that you'll have to pay, and these are typically associated with mortgages as well. So you'd be looking at paying legal fees, arrangement fees, and a valuation fee. But the one fee that doesn't typically come out in a mortgage is a repayment charge. So on a bridging loan, you'd normally actually have to pay a repayment charge, which is something you'll pay to the lender when you actually pay back the loan. Now, this isn't on every mortgage and the fees do vary. So it is a very wise idea to actually get in contact with a mortgage broker who can guide you through the entire process and actually give you the best product that is specific to your deal. Now, there are also various different repayment structures. So you could have a monthly interest payment where you'd have to pay the interest on a monthly basis, and this might get you a bit of a cheaper rate. However, if you want to help your cash flow while you're doing the project, you can actually just add the interest to the loan amount, so to the principal amount, and then repay the entire amount at the end. This can help with your cash flow, especially if you're quite tight on cash at the moment while you're rebuilding the property. And then once you sell it on, you have a lot more cash and you can pay off the entire amount. So bridging loans can be a very good thing to use, especially if you're trying to purchase a property that has an issue with it, which makes it unmortgageable. Now, of course, it does come at a bit of a cost, so it's important to make sure that you understand exactly what the terms are of the mortgage, and if it fits into the deal. You want to make sure that you're still going to make profit even after you pay off that higher interest rates using the lender. Now, I hope this video has been very helpful, and if you'd like more content about property and property investment, please like and subscribe and follow the channel for more content.